What if the next financial crisis doesn't begin with collapsing banks? What if it doesn't start with a housing bubble, or a wave of mortgage defaults, or even a dramatic stock market crash flashing across every news channel? What if the greatest financial threat of the next decade is already taking shape, quietly, while millions of investors remain focused on fighting the last war? For years, people have looked back at 2008 as the ultimate blueprint for financial disaster. Images of failing banks, collapsing home prices, and panicked investors have become permanently etched into our memory. Whenever markets become uncertain, the same question appears everywhere: is another 2008 coming? But history has a habit of surprising us. It rarely repeats itself in exactly the same way. Instead, it changes its appearance, shifts its direction, and catches the majority of people completely off guard. That is exactly what makes the next financial crisis so dangerous. The biggest risk isn't simply that another crisis could happen. The biggest risk is believing we'll recognize it before it's too late. Human psychology has always worked against us. We prepare for yesterday's problems while tomorrow's challenges quietly grow stronger. Investors spend years studying the last collapse, expecting the same warning signs to appear again. But financial history tells a very different story. Every major crisis has had its own trigger, its own victims, and its own lessons. Those who assumed the future would look exactly like the past often paid the highest price. Today, the world is facing a completely different financial landscape. Interest rates have changed. Government debt has reached extraordinary levels. Artificial intelligence is transforming entire industries faster than many experts predicted. Global supply chains continue to shift. Geopolitical tensions remain elevated, and technology is reshaping the economy at a pace few could have imagined just a decade ago. None of these developments automatically mean a crisis is inevitable, but together, they have created an environment unlike anything investors faced in 2008. And while headlines continue to chase daily market swings, some of the world's most disciplined investors are focused on something much deeper. They understand that the greatest dangers rarely arrive with flashing warning lights. More often, they build quietly beneath the surface until one unexpected event exposes weaknesses that few people were paying attention to. This is where Warren Buffett's investing philosophy becomes especially relevant. Buffett has never built his fortune by predicting the exact day a crisis would begin. Instead, he has spent decades preparing for uncertainty before everyone else realizes it exists. His success has never depended on guessing tomorrow's headlines. It has depended on understanding timeless principles that remain true no matter how the economy changes. So the real question isn't whether another financial crisis will happen. History suggests that periods of economic stress are inevitable. The more important question is this: what if the next crisis looks nothing like 2008? And if that's true, would you recognize the warning signs before everyone else does? There's an old saying on Wall Street: generals always fight the last war. The same is true for investors. After living through one major financial crisis, people naturally assume the next one will unfold in exactly the same way. It's a comforting belief because it gives us the illusion that if we can recognize the past, we'll be prepared for the future. But financial markets rarely reward that kind of thinking. The 2008 financial crisis became one of the defining economic events of modern history. Banks failed, housing prices collapsed, credit markets froze, and fear spread across the global economy. It was a crisis driven by excessive leverage, risky lending, and a financial system that underestimated its own vulnerabilities. For millions of people, those memories became the standard by which every future market decline would be judged. Since then, every period of market volatility has been compared to 2008. Every correction sparks headlines asking if this is the next financial crash. Every economic slowdown brings predictions of another banking collapse. But history teaches a different lesson. The Great Depression wasn't caused by the same forces as the inflation crisis of the 1970s. The dot-com crash looked nothing like the 2008 housing collapse. The economic disruption during the global pandemic followed an entirely different path. Each crisis had its own unique causes, and each caught people off guard in different ways. This is where psychology becomes one of an investor's greatest challenges. Our brains naturally give more importance to recent, emotionally powerful events, a tendency known as recency bias. We expect tomorrow to resemble yesterday because it feels familiar. Unfortunately, markets don't operate according to our expectations. They evolve as economies change, technology advances, policies shift, and human behavior adapts. Warren Buffett has often emphasized that successful investing isn't about predicting the next headline. It's about understanding enduring business fundamentals and staying emotionally disciplined when uncertainty rises. Rather than asking whether the next crisis will mirror 2008, a more useful question is whether today's risks are different from yesterday's. Investors who remain open-minded, patient, and focused on long-term value are often better prepared than those trying to relive the last crisis. In the world of investing, looking backward can teach valuable lessons, but looking only backward can also become your biggest blind spot. If the next financial crisis isn't likely to look like 2008, then where should investors be paying attention? The answer may not lie in one dramatic event, but in several quiet pressures that have been building beneath the surface of the global economy. On their own, each of these challenges might seem manageable. Together, however, they create an environment that is far more complex than the one investors faced nearly 2 decades ago. One of the biggest changes is the level of government debt. Around the world, governments have borrowed heavily to support economies through recessions, pandemics, and periods of slow growth. Borrowing itself isn't unusual, but as debt grows, so does the cost of servicing it, especially when interest rates remain higher than they were for much of the last decade. Higher borrowing costs can put pressure on governments, businesses, and consumers at the same time, reducing financial flexibility across the economy. Another major shift is inflation. For years, many investors became accustomed to low inflation and near-zero interest rates. That environment encouraged borrowing, fueled investment, and helped drive asset prices higher. But today's economic landscape is different. Even as inflation has eased from its highest levels in some regions, central banks remain focused on keeping price pressures under control. That means interest rates may stay higher than many people had expected, affecting everything from mortgages and business loans to corporate profits and consumer spending. Technology is also changing the investment landscape at an extraordinary pace. Artificial intelligence has created enormous excitement, attracting significant investment into a relatively small number of companies. Innovation has always driven economic progress, but history shows that periods of intense optimism can sometimes lead investors to overlook valuation and risk. Whether today's AI boom proves fully justified or not, it serves as a reminder that enthusiasm alone does not eliminate uncertainty. Beyond economics and technology, the world is becoming increasingly interconnected. Supply chain disruptions, geopolitical tensions, energy markets, and shifting trade relationships can all influence financial markets in unexpected ways. None of these developments guarantees a financial crisis, but they highlight an important reality: today's risks are more diverse and interconnected than ever before. That's why successful investors focus less on predicting a single dramatic event and more on building resilient portfolios and maintaining the discipline to adapt as conditions evolve. When financial markets become uncertain, most investors immediately start searching for predictions. They want to know where the market will be next month, whether a recession is coming, or when the next rally will begin. Television experts debate interest rates, social media fills with bold forecasts, and headlines compete to make the most dramatic prediction. Yet throughout decades of market booms, crashes, bubbles, and recessions, Warren Buffett has taken a remarkably different approach. Instead of trying to predict every economic twist and turn, he focuses on what he can actually understand and control. One of Buffett's most important principles is simple: buy outstanding businesses, not exciting headlines. A company with strong cash flow, manageable debt, loyal customers, and a durable competitive advantage is far more likely to survive difficult economic periods than one built on speculation alone. While market prices may fluctuate wildly during times of uncertainty, the long-term value of a well-run business is determined by its ability to continue generating earnings year after year. Another lesson Buffett demonstrates is the importance of financial flexibility. Berkshire Hathaway has often maintained substantial cash reserves, not because Buffett expects a crisis every year, but because cash provides options. During periods of market panic, investors who are financially prepared are often in a stronger position than those who are forced to react under pressure. Having liquidity allows opportunities to be evaluated carefully rather than ignored because of limited resources. Perhaps Buffett's greatest advantage, however, isn't financial, it's psychological. He has repeatedly emphasized that successful investing depends as much on temperament as it does on intelligence. Markets are driven by human emotions. Fear pushes people to sell quality assets at the worst possible time, while greed encourages them to chase investments after prices have already surged. Buffett has consistently resisted both extremes by remaining patient and disciplined, even when public opinion moves in the opposite direction. He also understands that uncertainty is a permanent feature of investing, not an exception. Wars, inflation, technological revolutions, political change, and economic downturns have all occurred throughout his investing career. Yet instead of trying to predict each event, Buffett has focused on owning businesses capable of adapting through changing conditions. His philosophy reminds investors that long-term success isn't built by accurately forecasting every crisis. It's built by making thoughtful decisions, avoiding emotional reactions, and allowing time and compounding to work in your favor. While no strategy can eliminate risk entirely, disciplined investing has consistently proven to be more reliable than chasing predictions. When the next financial crisis eventually arrives, and history suggests that, at some point, it will, the greatest losses may not come from the economy itself. They may come from the decisions people make while fear is at its highest. Time and again, financial markets have shown that panic can destroy more wealth than many recessions ever do. The headlines may change, the causes may be different, and the industries affected may not be the same, but one thing has remained remarkably consistent throughout history: human emotions. Imagine waking up to news that markets have fallen sharply overnight. Television anchors speak with urgency, social media is flooded with predictions of an economic collapse, and investors everywhere begin asking the same question: should I sell before it's too late? In moments like these, fear spreads much faster than facts. People stop thinking about long-term goals and begin reacting to short-term price movements. Instead of asking whether the businesses they own are still fundamentally strong, they focus only on the falling numbers flashing across their screens. This emotional reaction is one of the biggest reasons many investors struggle to build lasting wealth. During market declines, people often sell quality investments simply because prices have dropped, not because the businesses themselves have become weaker. Then, when confidence finally returns and markets begin to recover, many hesitate to buy back in until prices have already climbed significantly. In other words, they sell low because of fear and buy high because of optimism, the exact opposite of what successful investing requires. Warren Buffett has spent decades warning investors about this cycle. One of his most well-known ideas is that the stock market transfers money from the impatient to the patient. While countless investors search for the perfect prediction, Buffett has consistently emphasized emotional discipline over perfect timing. He understands that markets are emotional in the short term but have historically rewarded patience over longer periods. Instead of allowing temporary panic to dictate his decisions, he focuses on whether the long-term value of a business has truly changed. Another common mistake is chasing whatever appears to be the safest trend after a crisis begins. Investors often rush into assets that have already become popular or abandon carefully planned strategies in search of quick protection. While adjusting a portfolio thoughtfully can be reasonable, making sudden decisions based purely on fear often creates even greater long-term damage. Markets have a way of testing patience, and those who constantly react to every headline frequently end up exhausting themselves without improving their results. The reality is that no one can predict the exact timing, cause, or severity of the next financial crisis with certainty. But investors don't need perfect predictions to make better decisions. They need preparation, discipline, and the ability to separate emotion from analysis. Every major downturn in history has eventually given way to recovery, innovation, and new opportunities. Those who remained patient, focused on quality investments, and resisted emotional decision-making were often in a stronger position when confidence returned. The next financial crisis may look nothing like 2008, but the greatest challenge for investors will likely remain exactly the same: mastering their own emotions. Because in the end, the biggest risk is often not the market itself, it is allowing fear to make decisions that your future self will regret. If there's one lesson that history has taught over and over again, it's that financial crises are not unusual, they are inevitable. Every generation believes it is facing challenges unlike anything the world has ever seen. Sometimes those fears are justified. Markets decline, businesses fail, unemployment rises, and uncertainty dominates the headlines. Yet despite wars, recessions, inflation, technological revolutions, political upheaval, and countless market crashes, the global economy has continued to evolve, businesses have continued to innovate, and long-term investors have continued to build wealth. The lesson isn't that crises don't matter. The lesson is that they don't last forever. One of Warren Buffett's greatest strengths has never been his ability to predict the future. In fact, Buffett has repeatedly avoided making bold market forecasts. Instead, he has focused on something much more powerful: preparation. He understands that uncertainty is not an obstacle to investing, it is a permanent part of investing. Rather than trying to guess the exact moment markets will rise or fall, he concentrates on owning strong businesses, maintaining financial flexibility, and making decisions that still make sense years into the future. That mindset has helped him navigate decades of economic uncertainty without abandoning his long-term strategy. This approach stands in sharp contrast to the way many investors behave during periods of market stress. When fear takes over, people often become obsessed with short-term predictions. They search for the perfect headline, the perfect analyst, or the perfect forecast that promises certainty. But certainty is something financial markets rarely offer. The future will always contain unknowns. Interest rates may change, inflation may rise or fall, new technologies may disrupt entire industries, and unexpected global events can reshape markets overnight. Accepting this uncertainty is not a weakness, it's one of the greatest strengths an investor can develop. Another timeless lesson is the extraordinary power of patience. Wealth is rarely created through one lucky investment or one perfectly timed trade. More often, it is built gradually through consistent decisions repeated over many years. Compounding rewards those who stay invested, remain disciplined, and allow time to work in their favor. This is why Buffett has often described time as one of the most valuable assets an investor possesses. While markets fluctuate from year to year, the long-term growth of productive businesses has historically rewarded those willing to think beyond today's headlines. Perhaps the most important takeaway is that every crisis creates two groups of people. The first group sees only fear. They allow uncertainty to control their decisions, abandon their long-term plans, and react emotionally to every market movement. The second group sees the same uncertainty but responds differently. They stay calm, continue learning, evaluate opportunities carefully, and remember that periods of panic have often been followed by periods of recovery and innovation. The difference between these two groups is rarely intelligence. More often, it is discipline. So, will the next financial crisis look like 2008? Probably not. History suggests it will arrive in a different form, driven by different forces, and challenge investors in new ways. But the principles that have guided successful investors for generations are unlikely to change. Patience will still matter. Emotional discipline will still matter. Focusing on quality over hype will still matter. And understanding that preparation is more valuable than prediction will still matter. Because in the end, the investors who succeed are not the ones who correctly predict every crisis. They are the ones who build a strategy strong enough to endure whatever the future brings. And that may be the most valuable lesson Warren Buffett has shared throughout his entire investing career.